Ned Naylor Leyland, fund manager of the Gold and Silver Fund at Jupiter Capital, to tell us about how he thinks about exploration. Ned,
thank you, Simon.
There you are.
Can you hear me?
Gotcha.
Okay. Hello everybody. I don't have any slides today. I thought that I would just sort of riff about what we think is interesting. Obviously, as a fund, we have to think a bit differently about this process than maybe prospectors, geologists, even PA investors. It occurred to me that a PA investment in an exploration stock is quite different than when you have to think about it in a fund, due to obviously the liquidity profile there. The first thing I wanted to say though is I feel that this cycle does seem different than previous ones in a good way, and I think part of it is due to the lag from the last one. If you think about the depletion of reserves and the majors, things that are happening in the global economy, there's a real need for I think quite aggressive M&A to happen down the line, and I think capital will continue to be made available for these sorts of companies, which is exciting. And I think this cycle will be more powerful because there's also as Simon mentioned, I'm interested in the monetary system. I think that this is more of a monetary super cycle than a commodity super cycle, and that potentially will make what's coming in this area even more powerful than people realize. Particularly if you look at Doggy Coin with a market cap of 60 billion and realize that that's what sort of 50% more than Barrick, it gives you an idea of the amount of capital that potentially may come to play down the line when the market gets a sniff. I should declare an interest in DGO. We're a major shareholder, and Ed teed up various talking points for me there unintentionally. But he also mentioned that he's worried about the discount, and I would say that really, as an investor in DGO, I'm not worried about the discount. It's a reflection of a lack of sentiment and participation that I think will change, and I think it will change dramatically, because unfortunately all investment now is about what we call L, M, and N: leverage, momentum, and narrative. And our area, while commodities have a bit of sizzle at the moment, as an investment class, there isn't material momentum, the unfortunate component, of course, is leverage, but we have to discuss it because those monster hedge funds are an important part of the way that global capital moves around now. And I think that all of that will swirl around and come and end up in our area in due course. Now, in terms of what we think about when we're making an investment decision in exploration, well, there are a number of things that are very important. I mean, Ed brought up native interests. That of course is important, and increasingly our investors do care and want that handled. So I think it's something that can become or will become necessarily more important in terms of the way that exploration companies think about this. We have an investment charter that we give to our investee companies, and we discuss that with them. We think it's something that needs to be grappled with in due course. But in terms of those fundamental slots that we're looking for, of course, there's scale. That goes without saying. I think it's important not to get too enticed by grade on its own. We've learned that over the years, that grade doesn't necessarily mean that much. It can seem to be very exciting, but generally, the likelihood of you having grade and scale and good location is pretty unlikely. And of course, that's what led us to also be a major shareholder alongside DGO in De Grey. And so we were a major shareholder of both De Grey and DGO because we believe that project has all of those things, which is very rare, and you don't come across that, or rather we haven't in our investment careers come across that sort of opportunity. And with the scale point, which Ed touched on, but I would sort of further extend, is delivered via the most important thing in investing now, in my opinion, which is that alpha comes from insight. It doesn't come from data. People are very focused on data. Data is everything now. Data. You hear it all the time. And that's fine. And if you want to run a quant fund, then, and you think you can have a data edge, then maybe you can, or maybe you can't. I tend to think it's pretty difficult. But actually, all insight, really all alpha, is where, you know, the human looks at something and reappraises it. And what happened with De Grey, and I would argue probably also with Chalice, not that we're a shareholder in Chalice, is a reappraisal of certain things and a bit of risk taking, as Simon touched on earlier, where you think about it and say, well, this is wrong. Surely there's an opportunity here to reconsider. Now, of course, it's also true that nowadays you're likely to find major discoveries either at depth or undercover, you know, blind. And that's an important difference in maybe in previous cycles. But again, what with technology, which of course also has come along hugely since the last cycle, there are great opportunities there. And I really think that this is a very, very early moment for this whole conversation. I imagine that Simon, you know, I know he wanted me to wear spandex on this call, and I nearly fell for his chat. You know, this is, let's say, the first sortie in what I think will be increasing interest over the next 1, 2, 3 years as people seek out hard assets and continue to free credit and paper in their investment portfolios. So we may not be that popular now, but I think down the line, you know, you'll have a lot of participation in these kinds of events where people are looking for exactly what is being offered today during this conversation. I'm looking to my left to see what else is important because I've scribbled away on my whiteboard. And the other thing which I think is really worth mentioning and what we look for is for companies that don't fall in love and get married. Now that might sound a bit mean, you know, but ultimately a nice bit of constant window shopping and keeping your eye out is absolutely crucial for us in terms of investing in a junior. So whether we want to call it outright exploration or development or whatever we're talking about, in this slot in our portfolio, we want people to be on the lookout for new opportunities, as well as obviously trying to develop what they already have. Because one of the great problems is falling in love with your idea, your thesis, or your individual asset. And that's how capital gets tied up, and that's what we need to avoid as a fund. So I think probably with that, I will pass back to Simon and ask if there are any questions for me. Maybe I've given a bit of time back to the overall session. Is there anything question-wise?
Ned, thank you. And to invite the participants in the webinar to write your questions on the Zoom Q&A function, and Dana and I can read them out. So, Ned, as you look at the 6 companies presenting today, where do you think, or who do you think is the best allocator of capital there in terms of not falling in love, not getting married? Interesting marital advice there. How do you assess the company's abilities to not fall in love with their projects?
Well, I think that what we look for as investors, I'm not going to give you marital advice, is optionality. So what we want is we want a base load, something that we can value, and then we want lots of additional opportunities which are effectively not priced in. And while Ed may look at his share price and say, you know, that's annoying. For me, all that is just a free optionality. So that's what I'm looking for. Now, whether that's in terms of pure valuation or whether it's in terms of additional projects and obviously, you know, how much cash the company's carrying is important, because otherwise it's all well and good if you've got the project, you can't fill them, then that doesn't work either. But it's that balance there. Now, of course, obviously I'm gonna answer and say DGO because we're a shareholder there. But that's not to say that other companies don't have great opportunities, because the chance of us being invested in everything that's really great is 0. That's not going to happen. But it's about trying to maximize the opportunity set while owning things that have something that's clearly a base load, and then have the ability to go out and add to that.
Understood. So you, in a sense, Ned, you're looking for free options. You, in the case of DGO, you pay for the shareholding in De Grey, and you get everything else. Most importantly, perhaps, Ed's lifetime of insight and experience for free.
Yes, I think that that's also very important. Obviously, I'm not a geologist. Well, not obviously. I mean, maybe you might think I was one, but I'm certainly not a geologist, and I'm well aware that this is a very specialist area. So parceling up that expertise and making sure you have the right people to lean on, but also, what we tend to notice as a team is that the more experienced people are, the less likely they are to fall in love with one idea or one project, because they've been through enough cycles to know that even if it's right, it may take 3 goes at it. So, as I think was touched on earlier in the conversation, this came up. It's just about having those opportunities, sitting there, and also having management participation is very important too. Feeling that you're in it together with a management team.
Very good. So Ned, thank you for those insights. We're going to invite you to join the group panel, which is after the next speaker.